Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. I met him up in Toronto. I'm excited to have him on. I've been following his work for a number of years over at Sprott. It's John Embry, Chief Investment Strategist. Let me just read his bio really quick. He plays an instrumental role since joining Sprott in March of 2003. He's over 30 years in the gold market and gold sector. He's been a portfolio management specialist since 1963. And in 2002, he had the number one ranked fund across the country in Canada, net performance of 153%. It's pretty fantastic. So thank you for joining us, John Embry.
It's my pleasure, Jason. I look forward to the conversation.
Now, John, you gave a very interesting presentation in Toronto when I was up there at Sprott headquarters. You said in your presentation that you have been wrong because you were surprised about the amount of financial engineering that has occurred in all markets. What type of financial engineering are you talking about exactly for our listeners who are unfamiliar?
That's a good question, because I've been in the business over 50 years. And, this is not the market that I grew up in. When I talk about financial engineering, I think it relates to the massive amount of computer power that's been developed over the last 30, 40 years. And it's being applied in such things as high-frequency trading, algorithm programs, massive utilization of derivatives and what have you. And all of these things permit, a degree of market manipulation and that was never possible before. And as a result, I think what we've seen latterly is price action, which is really not reflective of what is truly going on behind the scenes.
Yeah, I would completely agree with that. It just seems like we're not seeing supply and demand fundamentals. Like, look at the oil market right now. The demand for physical oil, demand is up for oil, and yet, the oil price has dropped because the dollar has been strong or whatever financial warfare has gone on behind the scenes. And then obviously in gold and silver, it looks like that. But, these high-frequency trading programs, they're skimming, pennies off every single trade?
Yeah,
so they're front-running.
Yeah, absolutely right, Jason. And more so, they can basically, put enormous pressure on markets just by rapid-fire selling that can go on as long as they want it to and can break other longs and force them to sell. It's changed the whole market.
Yeah, it looks like they blow up stops, and then we've seen the evidence come out with the central banks that they're trading in illiquid hours. They're getting actually, I guess, discounts from the Chicago Mercantile Exchange to trade that, and then it looks like these high-frequency trading programs, they know where to blow out the stop. So, obviously for gold, the key support level was at 1180. I guess every single trader had a stop at 1180 or a limit order or something at 1180 to sell if that support level is breached. And, these trading programs just went in there and blew up the stops. And I guess it was easy trading profits for them on the downside.
Well, that was a very brilliant analysis you just did, because I believe that's exactly what happened. And that's what's been going on for quite a while. Basically, the powers that be, the central banks, their agents and what have you, they get these down moves started, but then it sort of gets the traders in behind them, and it just amplifies the moves, and then the longs get out of the way. And so you're getting price action that we would never have seen 30, 40 years ago.
Yeah, I agree. It definitely looks like the charts are painted, and I don't know about you, John, but you said the business has changed. The financial professionals I talk to, the ones who aren't Austrian School Economics, who are Keynesian or mainstream Wall Street people, they won't buy something with a bad chart. So I think a lot of the powers that be, they understand this, they know this, and they know that all they have to do is just manage sentiment and then just make sure the chart doesn't look good, and then no one will hop on board, and people, will actually, join their side and short.
Well, that's exactly what's happened. And what it's created, is undervaluation of a historical magnitude. We can talk for hours about sort of what the value of of gold and silver should be in current currency. But I can assure you it should be materially higher than it is. And because of the price action, it drives most of the people away from the market. They don't care about value. They just care about the fact that it acts horribly. And even though the fact it acts horribly is because of extreme manipulation.
Yeah, I agree. A lot of friends who are even financial professionals, ones who were longtime gold and silver bulls, a lot of them are starting to throw in the towel now. I mean, we're just at the point where even professionals who have cash on the sidelines who are committed gold and silver bulls, a lot of them won't buy here, and they're citing the chart reference, how bad the chart is. They think it could go down to 1,000 or something
Yeah, well,
like that.
that's the message that's out there. I mean, as you know, Goldman Sachs came out some time ago saying gold was going to 1,050. I mean, basically, that seemed to me to be the game plan. Whether or not they can get it there, I question. I think there is sufficient physical demand in other parts of the world that could care less what we think, but we shall see.
Yeah, before we talk more about gold and silver later in the interview, I just wanted to stick with the macroeconomic questions. Are you surprised that these Keynesian central planners have been able to kick the can down the road in Japan, Europe, and the U.S. and keep this game going longer than many thought possible after 2008?
Not really. I mean, I am, as you know, a committed Austrian economist. And I mean, as von Mises said, when you reach a stage like this in a credit cycle, you have one of two outcomes. You can voluntarily sort of trigger a debt deflation and clean the debt out and start over again. Or the more expedient thing to do, because nobody wants to be in control when a debt deflation occurs, the more expedient thing to do is just keep jamming enough money into the system, high-powered money, to make sure that the financial system remains afloat and the debt can be serviced. And I think this is the game they're playing. There's only problem with this that, so far the velocity of this high-powered money has been dropping, so we haven't seen any dramatic price impact in the real world. We've seen lots of price impact in the various markets, but not in the real world. However, I mean, all this is, in the currency game it's a confidence game. And at some point, if they keep doing this, and I think they will keep doing it, confidence in currency will be lost, and there will be a massive attempt to sort of unload it, and at that point velocity explodes and we're on the road to hyperinflation. I think that's where we're going, but that's allowed to keep the game going longer than many thought possible.
Yeah, these central banks, they managed to keep most of that inflation, like you said, just in the asset prices, or the central banks in the developed world, so the U.S. and Japan. They managed to have, the monetary policy from the developing world. There's all these dollar pegs or other countries trying to, go into the markets there and maintain their fixed exchange rate, and they're playing games. And in order to do that, they're importing the inflation. They're importing the inflation the U.S. and Japan export.
Well, that's an excellent point. I mean, one of the reasons why you're not getting any inflation to speak of, you are getting more than they're acknowledging, but you're not getting any rampant inflation, is the fact that the economies at this point are so weak in the Western world. I don't believe for a minute the U.S. is as strong as they're trying to maintain. And we know for a fact that Japan and Europe are literally basket cases at this point. And so consequently, the only antidote to that is to keep jamming money into the system. And as you correctly point out, this money's going in every which way. But at this point, it isn't sort of driving rampant inflation in the Western world. This will change if confidence is lost in the currencies.
Yeah, I agree. And to give you a real-world example, I live right outside of Washington, D.C., which has, obviously the lobbyists and the politicians and big government here is doing pretty good, but the majority of people on Main Street are not doing very good here. Most of the private sector jobs here, John, are entry-level jobs. They're part-time. They're only paying, $8, $12, $13 an hour. You're lucky if you can get a full-time job between $20,000 and $30,000 a year, maybe $40,000 in the private sector, no matter how many degrees you have.
Well, but it doesn't make any difference. Didn't Hillary Clinton say that the government creates jobs? We don't need the private sector?
Yeah.
She did say that, didn't she?
Yes, she did. She did. I think she's been letting her Marxist ideals slip out a little too much. Maybe too much Saul Alinsky there. Let's move on to the next question here. The wealth effect, financial repression, changing the inflation formulas. How much longer are these guys, the people in power, the Keynesian central planners, going to be able to get away with this?
That is the question that has no obvious answer. We don't know. I mean, I will make the point, Jason, that we have never in the history of mankind been in a situation like this with the degree of leverage that has been built into the system. It's just not the massive quantities of debt, which we are all aware of at all levels in all of the Western world, and in China for that matter. It's piled on top of this is this obscene amount of derivatives, much of which is levered to interest rates. And so consequently, I mean, there's so many possible black swans that could put this thing off the rails, but you can't nail the timing. All you got to know that if you better be 6 months early rather than 5 minutes late when this thing changes course.
Yeah, I agree. The timing is the most tricky. People always ask me to give them a time, but I was like, the rules keep changing. I think that's the most important rule is they keep changing the rules. A couple of years ago, it looked like all the markets were going to crash. I think it was in November 2012 or 2013. And then, all the global central banks, all the most powerful ones, they met overnight. They had conference calls, and they announced, currency swaps or these other types of packages, and the markets were up the next day. So when it looks like, things are about to crash or rationally things should crash based on fundamentals, the markets just keep going up. So it just keeps defying reality here. I think we're in fantasy land. I have no idea how much longer this thing could keep going because they just keep changing the rules. And to use a sports analogy, they just keep moving the goalposts.
But I'll tell you something. Yeah. You used an analogy for a couple of years ago. We had the same experience 2 weeks ago. I was overseas and the stock market started to crash. And I thought, this is interesting. And then all of a sudden, after it had fallen over 1,000 points, it reversed, and the Dow ended up going almost to all-time highs. And yet, if you looked at the fundamentals continue to deteriorate. I mean, this is central bank intervention that is keeping this thing afloat. And at some point, it's either going to lead to hyperinflation or they're going to lose control and the whole thing's going to collapse. They're both horrible outcomes.
Yeah, I mean, to get the exact timing on this is just impossible. I think it's a fool's game to try to get the exact timing on it.
The thing that's really important, and I think, is that people understand what they're dealing with. Like, I think the mainstream media is misleading the public so badly, and I think that many people in the public have sort of a cognitive dissonance. They do not want to deal with what's going on, so they listen to somebody that's patting them on the head saying everything's going to be fine. I think this approach is fine in the short run because it keeps you alive, but it's going to be absolutely disastrous when the worm turns.
Yeah, it seems like the mainstream media is selling hopium here at this point. Like, every piece of data, whether it's, that the part-time jobs or the majority of jobs being created, not full-time jobs, they're counted now. The part-time jobs are counted the same as full-time jobs. Everything is spun as positively as possible. And, when there's guaranteed downward revisions or seasonal adjustments later in GDP or anything like that from the Bureau,
that never gets any publicity.
Exactly. Now, let's transition, John, to gold and silver.
Yeah, that's an important subject here because they've really done a great job in destroying the sentiment in the sector.
Yeah, and also the charts. Now, you mentioned also about GLD and SLV in your Toronto presentation. Do you think there's as much metal as advertised in both of them?
No, I don't. I think both of these things were brilliant constructs from the point of the central planners because it's given them an inventory of gold and silver to access when they need it. And also what it did was it siphoned off a massive amount of gold and silver buying that would have, in the old days, gone into physical metal. And it went into these paper products that were allegedly backed by, real metal. But I think that, they don't have nearly as much probably as they admit, but more importantly, they can sort of take it in and out when they need it.
Yeah, and you mentioned that they could potentially both of them be empty at this point, and I think because of the laws of the prospectuses and the way they're written.
We'll never know until it's too late.
Yeah, and there's a whole bunch of, lawyers speak in there, and basically I think they could take all the metal out if they wanted, right, and just replace them with more shares, right?
Yeah.
And
my advice to your listeners and to people, and it's in general, has been consistent. I mean, if you want to own gold and silver, you must either own it in physical form in your possession or in a vault that you trust implicitly, or own a paper product like, say, for the one that Sprott provides, where we can guarantee you, and it's regularly audited, that the gold is there and every ounce that's backing our piece of paper is as said. Most of these other gold vehicles, paper vehicles, you don't know. And my suspicion is many of them don't have any backing whatsoever there other than they replicate the price through derivatives and what have you.
Yeah, I agree. I think if there is any metal there, it's probably, hypothecated and or
Well,
owned
yeah,
by
that's
it.
another good point. I mean, if it is there, it's probably how many claims is there on it?
Yeah, I think Ned Naylor Leland mentioned that, one of the bars, CNBC, a couple years ago, when they were going through the vaults in GLD, it was owned by another gold ETF. Yeah.
It's very frustrating because there's just so many aspects to this. Like, as you know, I've been very outspoken on this subject for many years, and I believe that the U.S. says they have 8,162 tons or something, and I say, fine, prove it, have an audit, and then I'll believe you. But they haven't had an audit since Eisenhower was president. So what does that tell you? And it's just, this is one of the great Ponzi schemes of all time, this paper gold market and the gold market in general.
Yeah, I agree. And there's just ample proof, that they've been trying to manipulate the gold market for a long time, whether that's the London Gold Pool, overtly.
Well, that was a long time ago. That was 50 years ago they started with that. And yet, then they quieted down. But I've got documentation, great book called The Gold Cartel by a chap named Dmitry Speck. He's got chapter and verse to the day it started, the latest bout, back in August of '93. That's 21 years ago.
Now, I want to talk about the supply-demand of gold. You've been investing successfully in mining stocks for over a decade. Is there any more costs for primary gold and silver miners to cut without actually shutting down their mines, or have the miners run out of ways to cut costs and stay in business and keep mines open?
That's an excellent question. I have a lot of thoughts on this, and that is, if you've got a mine, an ore body, this is a valuable resource. And to dig it out of the ground at a loss, and a lot of them, if you fully cost for all the expenses, including capital costs and exploration and everything, these people are producing their valuable gold out of the ground and selling it to these bullion banks at a loss. That's preposterous. I don't think they can. One way you can get your costs down is by high grading your ore body, but that leads to problems down the road. I think that's going on now. But I don't think there's a lot more avenues they can go with, to cut costs sufficiently to deal with these current prices that are dramatically, in the case of silver, below, the full extraction costs.
Yeah, I agree. And, silver, unlike gold, silver is used in a lot more industry. I think 50% of all the annual silver supply, right, is used for industrial purposes.
It's closer to 75.
Okay, so 75% of silver then is used for industrial purposes. So that silver has to be used, for electronics or solar panels or different types of things.
The one question I can't answer, and I talk to all the great silver mines in the world, the guys who think about this talk about it. No one quite understands where the physical silver is coming from at these levels to meet what I think is pretty robust demands for both industrial uses and for investment purposes. You've seen the recent Silver Eagle sales and what have you. People are buying it at this level because they know it's cheap. So where is it all coming from? I can't answer that.
SLV, right?
Well, some of it's SLV, and I don't know whether there's a secret stash of silver we were unaware of. All I know is that over the past 50 years, massive piles of inventory that were accumulated after the Second World War and then after the Hunt brothers tried to corner the market, that's all gone. And so, the above-ground inventories of silver are minimal, and yet there's still enough to sort of keep this price suppression scheme going. It's quite remarkable.
Yeah, it's very interesting, and it seems like the miners, while the metals price is rising, they can handle the debt levels, but I think the mining industry needs to get away from using so much debt to basically a mining company, a smaller one at least, they have to bet the whole company, right? They have to bet the whole company on one mine. They have to take out an enormous amount of debt to put the mine into production. I think the industry needs to get away from this model where they're using so much debt, they're so beholden to banks. In order to do that, we need more royalty and streaming companies in this industry so the miners aren't taking as much debt. So if the price does drop below the production cost, they don't have to sell then.
That's a good point. You are really, trapped in this environment. You're probably as good as dead if these prices were to be maintained for a long time. If you're carrying debt. If you don't have debt, you can shut your mine down and say, I'm not going to sell my valuable resource. I'm going to mothball it until prices reflect reality. But if you're in debt, you don't have that option.
Now, Sprott's companies do private placements with miners for equity and warrants, and also lend to miners with good project economics. How much debt and equity is available to miners at this point?
Well, I would say a relatively minimal amount. I mean, we'd certainly look at deals right now. I mean, it's a fantastic time actually to be investing in it, and we are doing it. But I would say, collectively across the board, it's probably because of the negative sentiment in the sector, it would be relatively little is available, particularly because some people would say, well, these things aren't economic. Why would I lend them money?
Yeah, it's an interesting point, and now we're at the point here where people don't want to give anyone any debt or equity. But I'm surprised we haven't seen as much mergers and acquisitions at this point. Why aren't the smaller miners who can't get that debt or that equity? Why aren't they giving up and selling them to better selling their company to better capitalize larger miners and to at least survive that?
Well, that's an interesting question, and I would have said, I would have agreed with you. But now, I mean, the larger companies are being heavily impaired by what's going on. And I don't think their executives have confidence at this point in the future of their industry even. Like, I think people are very demoralized. And I think as a result of this, there's relatively little activity going on in the merger and acquisition field. I think the far-sighted person who has the capacity to do it should be, just scooting around buying all, these remarkably inexpensive ore bodies and just mothballing them until the economics improve and you'll make a fortune.
Do you think that's the game plan for China maybe at this point?
I think it is for China, and if I get really conspiratorial, I'm not so sure that the guys that are basically suppressing the price probably aren't the ultimate buyers of this stuff.
That's interesting there that Wall Street would turn after they made a whole bunch of profits on the short side, that they would go along on this.
It'd be brilliant, actually. I mean, basically, they've got all the traditional holders and buyers demoralized, and they can scoop it all up at bargain prices. And and it will rebound, because I mean, I believe firmly in this idea that China has accumulated massive quantities of gold, and they're just waiting for the appropriate moment for the revaluation.
Yeah, it seems, John, that China, Russia, and India are buying a combined more than 100% of annual gold mining supply, according to
more
Kuz.
than 100%.
Okay, more than Kuz Jensen's research. So
well, no,
you think those
Kuz says, he says China's virtually taken it all, but I mean, if you put the three together, yeah, I mean, they're hoovering up more than is coming out of the ground. So clearly, there's above ground inventory headed that way too.
Yeah, and I mean, supply-demand fundamentals, I mean, demand is clearly rising, right? At least not out of the West, not here in the United States. People won't buy gold.
Not the United States. I've got a contact over in London, and he claims that there's some big European buying coming in now. And I mean, when you sort of superimpose that on what's coming out of the East, I still think that it's just a matter of time before the physical market supersedes the paper markets in terms of setting the price. And I think that's where we're headed. It hasn't happened yet, but I suspect that you can only do it with so long, suppress it with paper, because you're going to run out of physical.
Yeah, exactly. I think the West is definitely running out of physical. I think I've read, Sprott Markets at a Glance for years, and you guys have provided a lot of data saying, this is not sustainable where a lot of physical metal can go from west to east with the paper price falling too. It just doesn't make any sense. There's no incentive for the miners to continue to provide more supply. And there's just no way the price can stay this low because, the gold bears will bring up the gold stocks to flow ratio, but, most of that above ground gold, it doesn't really change hands, right?
That's correct. And I mean, but there's other aspects that people don't realize. I mean, right now, I believe that the mines are high grading, and at the same time, mines are being depleted. And exploration is ground to a halt because of the fact that there's no money flowing in that direction. This is going to have a dramatic impact on the amount of gold production coming out of the ground over the next 5 years. And I could sit here and tell you the gold price is going to $10,000 within the next 5 years, and the amount of gold coming out of the ground is actually going to decline. This is exactly what happened in the 70s. I mean, gold went from $35 to $850. And there was more gold being produced at $35 than there was at $850. I think we're coming up to a period exactly like that.
Wow, I did not know that there was more gold being produced at the lower price than at the higher price.
No, but then in the succeeding decade, they got into open pit mining and everything, and there was a huge expansion. But in that window between 71 and 80, gold production actually declined.
Yeah, and the mining stocks went crazy after that.
They went
Although,
bonkers.
yeah.
And I suspect that, if I'm right, these things are going nowhere without a big move in gold and silver prices, but I think that is in the cards. And if I am correct, the mining companies that survive and the ones with good ore bodies in the ground that are just sort of husbanding them and not doing anything at this point, these stocks are going to go bonkers because there's going to be so few available vehicles and so much money looking for exposure in the area. My partner Eric Sprott has said that he can see 30 and 40 baggers in some of the best opportunities. And I used to say, I'll settle for 5 to 10 times. But, he could well be right.
Yeah, they've knocked down some of the most quality ones. Like Goldcorp and Pan American Silver.
Awesome.
It just seems.
I own Goldcorp personally, and the thing's been cut in half almost.
Yeah, these are quality companies that have multiple mines. They know how to cut costs. It's not just one mine and one company in one riskier country or something like that. It's a diversified company that understands the mining business, and they know how to produce how to profit normally. Well, not at the time right now. I don't think anyone really.
I don't think unless you've got a really high grade mine and you're going to have trouble producing at a profit. I think an interesting sign in the wind was the other day. Keith Neumeyer at First Majestic said he was going to start reducing production. He's got one of the lower cost mines, and I think that's important. That some of these guys are going to have to give their head a shake, and if basically they start restricting the amount of silver and gold coming to the market, eventually that's going to have an extremely positive impact on the price.
Now, John, I think eventually we are going to have the cycle turn. The cyclical bear market is going to end at some point. I don't know exactly when, but when the cyclical bear market does end and gold and silver finally start moving higher and the miners start moving higher, what is the likelihood of gold being confiscated or a windfall profits tax for owners of gold in the U.S.?
I don't know that it'll be confiscated because there's too much gold in the rest of the world, and the confiscation that happened in the 30s when Roosevelt was at the helm, that was a little different. It was basically backing the U.S. money, and it was a big deal. Now gold is kind of like a sideline in the United States, and gold's a big deal in India and China. So if the U.S. confiscated it from their citizens, I think this would have a very salutary impact on the price, and would work to the advantage of the Chinese and the Indians and the people that have all the gold. So I'd be surprised if they did that. Now, the second part of the question, the excess profits tax, I would be willing to bet that if gold went to $5,000-$10,000, which I don't think is out of the question because it's basically just the flip side of the debasement of money which is coming. At that point, I suspect the government would be desperate for money, and I'm sure there would be some sort of a excess profits tax.
Yeah, but they wouldn't be able. The U.S. government probably wouldn't be able to go after Canadian miners or Mexican miners, right? So unless all of these different governments coordinated with the U.S., I don't think that would happen. And I don't think that Canada or Mexico would voluntarily, risk destroying their mining sectors to go along with the U.S.'s policy decisions.
Well, I sincerely hope not, because it's an infinitely more important endeavor in Canada and Mexico than it is in the U.S. It's really small potatoes the amount of mining there is in the States relative to the GDP, where that is not the case in Canada and Mexico. So I hope that your observation would prove correct.
Well, John, I just want to thank you again for your time here. Could talk about gold and silver markets with you for a lot longer, but I want to keep the interview at 30 minutes. So please tell our listeners more about the new Sprott Gold Mining ETF, because I think that's a good option for people here at these levels. I think the valuations are good, and you guys do a lot of the screening for fundamentals for some of the gold and silver stocks and also the other Sprott physical ETFs.
I think it's very important that this is a great opportunity to buy a Sprott our gold ETF because we actually select the stocks. We're just not basically just doing an index. And we got some very good young analysts, and we're going to invest in the best stocks. It's an astounding opportunity, in my opinion, from a longer-term perspective, because these stocks have never, I don't believe, ever been cheaper in relation to the price of gold and silver, which are depressed in their own right. So I think you got a real double banger coming. When gold and silver rally, the stocks are going to go nuts, and our ETF is a good way to play it.
Well, John, I just want to thank you again for your time, and hopefully we can have you back on again soon to talk about the gold and silver market, like I said, because I enjoy talking about it, and I've been reading your work for years and listening to your interviews, and it was a pleasure meeting you up in Toronto.
Well, it's been my pleasure, and I hope your listeners take advantage of this because it's a rare opportunity.
It's very difficult, John, to buy when there's blood in the streets, even if you're on. I mean, it just seems like, things are, even the quality shares are going down 5-10% every single day. People, who have been buying dips, or they're not buying them in tranches properly, they're not waiting every 20% drop to buy a little bit more. People, have been putting too much capital into too high prices instead of, buying in tranches and things like that. It's very difficult, and like you mentioned this earlier in the interview, with sentiment control and controlling the charts, it's very difficult for people, even when they know the fundamentals, when they see charts bad, they think, there's some type of information they're missing or something like that.
Yeah, you're right. I think the key is, if you do buy, and I think you should, no leverage and buy carefully and just maybe sort of dollar average in.
Yeah, exactly. And I've been buying physical metal, but I don't view that as an investment. I view that as insurance. And then, the miners.
The miners are your speculative play or leverage. The gold and silver bullion is kind of your lifeline.
Exactly. Well, thanks again for your time, John. I appreciate it, and hopefully we can talk again soon.
Absolutely. Anytime, Jason. It's been my pleasure.